All right, good afternoon, everybody. Event Trader here, about to be joined by Brett Manning, Chart Trader. Brett, we got markets breaking down to the session lows here in the NASDAQ, keeping an eye out on the S&P. Very similar action, dipping down to 39.30. Any early thoughts to this action? Both of us, I know we got short. Unfortunately, both of us got squeezed out a little bit there and missing some of these gains, but we had the direction right following the Fed. So, what's your early take here on today's action?
Yeah, so I think the biggest thing that I see right now is what's happening in crude oil. This is when we're seeing that this isn't just a growth stock phenomenon as rates move higher, and I think part of it is probably what leaked in the Nikkei last night. That Japan is going to start to turn the ship around at least a little bit, and start to tighten policy. And I think that they're the first major central bank to hint at that. So,
PBOC had already been hinting about tightening, correct?
okay, sure. Outside
Yeah.
of China, yeah,
Okay.
where China kind of exists a little bit in a different universe sometimes.
Right.
But yeah, out of the major reserve currency central banks, to see them hit in that direction rather than hold the party line that everybody else has been holding, and basically, make the same kind of statements that we heard from Powell yesterday, to leak that, they're starting to tighten things, at least on some level. It's maybe sort of the first tremor of a different paradigm of reality hitting, and it looks like we're shaking the juice out of crude oil today. It's broken the trend line. We're down near testing the 50-day. Just in one day, I think it got down by almost 8%. And that means, it's no longer just that straight kind of rotation trade. So there's pieces of the market that had been holding up when growth stocks were falling that are starting to roll over now. And I think crude oil joining that downside movement is a big symbol of that.
All right. Now, when we're talking about Japan, obviously, as central banks go, they probably don't have the greatest credibility, right? I mean, uh, are you kind of surprised that they are one of the first ones looking to change ship, considering they're the ones that have been trying to get out of a deflationary spiral for about 30 years now?
Yeah, I mean, and I think it's just if I were to, my own personal view is they had a range established. They've been doing some form of curve control for a while, and they've been really active at the long end of the curve, and it's just impossible for them to continue to do that. So when you're going to lose that battle, and you don't want to lose your credibility in the process, so you have to make an adjustment. I think it's more about following the pressure of interest rates than really about dictating a change. Probably was impossible for them not to do this, but it still has the same net effect.
The carry trade, is that being impacted here? Is this part of this equation?
No, I don't think that the yen has really been a central part of that, but it's certainly not spiking.
Yeah, yeah. So it's definitely something to keep an eye out on. Now, in terms of just circling back to what we saw from Powell yesterday, on a second thought process, was there anything that jumped out to you with what he said that you thought was a bit of a game changer on a second round, or are you pretty much still in line with what you were seeing from yesterday?
Yeah, still the same thing. In fact, the surprise is that we had the blip in there where rates weren't rising. I think that was, I remember sitting here yesterday thinking, how do I figure out how to assimilate the fact that what he's saying should be radically steepening the curve, but it's not. And then I guess really it was just a case of waiting a few hours.
Yeah, yeah. Then you got the pop up here, but I mean, you obviously got that jump in rates, but they've been pretty trading in a pretty tight range throughout the course of the day. Um, do you think that the path of least resistance still up to the 2% level at this
It was,
point?
I mean, sure, it seems
Yeah,
like it. Who knows? It's a market, but
yeah.
the trend it really is parabolic. If you look at it on any time frame where you look at the curve of the rise from, let's say, last summer, it's just a gradually exponentially accelerating upside move. Parabolic trends tend to have a kind of blow off phase. And we thought maybe we had it a little bit when the belly of the curve busted on the 7-year auction a few weeks ago. It kind of had that look to it, but we marched right back through that tail, which would suggest that that maybe there's some orders out there, some people out there who haven't capitulated yet, that are going to capitulate into a low liquidity tape, and that could rapidly get us up to 2%.
All right. So Let me ask you this, Brett. One of the things that I was asked earlier from one of our subs was how much do you think taxes are having an impact on the markets here? And you had an interesting dynamic back around the election time and heading into the Georgia Senate runoff, where you were talking about the idea that perhaps the market would like a pure Democratic Senate, not taking sides from a political standpoint, but from the idea that legislation would be able to work its way through. Now, we saw that the stimulus package was able to be pushed through pretty quickly via reconciliation. Now there's a growing thought on the flip side that we could see um, taxes pushed through in the same manner. And there's a little bit of a growing concern on the tax front there. Do you think that's playing a factor into the current market activity?
I don't know. I have no way to gauge that. What I can say is that my point before was when you have a situation where if there's a coordinated policy from either party, as long as there can be actions taken in a context like this, when there's so much low-hanging fruit growth possibility because so much is shut down, right? There's so much pent-up demand, and at the same time, so many people on the sidelines in a situation where they could easily be put back to work as long as there's coordination, we reopen efficiently, then regardless of which party's doing it, regardless of what the underlying philosophy is, as long as it could be a coordinated process of just getting basic common sense things done and being able to tap into the biggest balance sheet in the history of the world to invest in that process, regardless of the politics of it, the only thing that really stands in the way there is having a situation where you have sort of hyper partisan haggling and no ability to really do anything, and paralysis in a situation where you're just standing in front of an easy opportunity to start to push things forward and exploit some of that pent up potential. So I think the market took off after the Georgia situation because it just reduced the likelihood that there could be politically driven stagnation and stalemates around every turn trying to do anything at all. And I think we really just suddenly you open up this big balance sheet. There's a lot of growth potential there. There's a lot of people that don't need to be out of work that are out of work. There's a lot of issues that can pretty easily be solved. It didn't take a rocket scientist to figure out some basic common sense steps to just get the ball rolling. And I think just putting it in one team's hands or the other is something that the market would prefer in that situation. A lot of times the market prefers a little bit of gridlock, but I think in a situation like that, it was particularly the opposite situation.
Now, do you think that the market could be a little bit concerned with these higher rates of just the amount of fiscal stimulus that's coming through? I mean, obviously they'll find ways to push liquidity in, and when you're looking at the greater context of things, a rise to 1.75% in the 10-year bond yield is not really necessarily a scary thing. We ran above 3% for probably the majority of the life of the 10-year yield. So, do you think too much stimulus is a bad thing at any point for the markets?
So I don't think that it necessarily is a bad thing, but I think any adjustment like this, we're going through kind of a paradigm shift, and any adjustment, there's going to be some big bumps. But that doesn't necessarily mean it's a bad thing, quote unquote. It just means the whole system is reorganizing around a different underlying premise. There's a different level of, salt in the water, so different species are going to thrive, right? I mean,
Right.
there's a change in the basic functioning of the ecosystem let's look at the most simple way to state what's happening right now is the expected return on invested capital for the first time in a long time is being extrapolated to be better now than in the future. And we've been living in a market world where for a long time the expected return on invested capital was better in the future than it was now. And the difference between those two things is anybody who's in possession of capital would prefer to be a lender in the world that we've been living in, and suddenly people would prefer to be a buyer. And I mean, buying a bond is the process of lending. So you can take that money. In other words, the one thing we saw, and we'll get into the fund manager survey in a minute, but one thing that we saw in there is the one thing you can absolutely be certain of is that everybody is aligned on the factor that we're going to see a strong economy in the near future, which means the return on invested capital, buying more capital equipment, buying a new business, opening up a new factory, whatever, those are all going to be strong return decisions. You're going to make a return on that capital. It's better to do that than to lend it to somebody else. People want to invest that capital now because everybody's really gung-ho about the economic opportunity right in front of us, rather than wanting to lend it out to somebody else now because in the distant future, you'll want it back because then you'll have something to invest in. So the expected return on invested capital is higher now than in the future, and we've been living in a world where it was higher in the future than now. That's a different ecosystem, and that's what's changing fundamentally. And there's going to be a lot of reorganizing processes. We're seeing the main thing is the rotation. So I think that's a just good, easy framework to conceptualize. It doesn't necessarily mean bad or good. It's just going from one sort of market to another.
Yeah, and I mean, obviously, you see a market like today where we're continuing our slip lower, but when you pop that into a daily, all of a sudden this doesn't look like all that big of a move, right, Brett? I mean, very, very similar to what we saw in mid-February with a bit of a roll. So we're getting a little bit more of that going on here early on. Now, I guess two things I wanted to talk to you about here, Brett. One is just kind of circling back to the oil commentary that you just had, where we're seeing it slip down below 60. So central bank tightening is being kind of given for the reason here. Do you see other issues that could be at play? Because for me, if you're looking at central bank tightening, you're still going to have the supply issues that you were talking about a lot the last couple of months in terms of people just have been slow to turn back on the spigots. Now, perhaps they have been moving a little bit quicker, and that's part of the reason. And we'll be getting some signs of them producing oil at a little bit of a faster rate than they could keep up with. But I guess the point being for me would be this would seem like a potential buying opportunity for oil, given the supply-demand situation that we know if this is around central bank policy. You tell me why I would be wrong in thinking that's a buying opportunity.
No, I can't tell you that. I would agree with you. So we got a little bit crowded. We got a little bit of momentum money in there. We hit very, very important resistance. There's a range, goes back to early 2019, three major peaks right along the 63 to 66 area. We poked just above that after going straight up from 34 in a couple of months. Hit that point. Every trend's going to have moments like this. I don't necessarily think that this is the top in crude oil. We got a little bit crowded. There's a little bit of speculative money that had piled in. It became an obvious trend to everybody, hit a major technical resistance point, and then it's looking for an excuse. And you're really going to go ahead and go to max pain on the late money right now, probably, and then probably that will signal some kind of buying opportunity.
This little shakeout, would you have an area on the stream, either the refiners or the E&P, that you'd be focusing on a little bit more?
So I'm after listening to and seeing something of what Chevron talked about in their Investor Day presentation. So they had made cuts to their willingness to invest over the last year, a pandemic budget, a balance sheet repair agenda, where they were cutting down on their investments by 35% for that period. Recently, they said, we're going to keep that in place for the next 5 years. If you are in the business of producing oil, you own large reserves, you get valued on the basis of those reserves and your ability to borrow against those reserves and produce them. That's a good business to be in a world where major integrated producers are not investing in much exploration and development of new production capacity. It's a bad business to be in if you are an equipment and service provider that doesn't have major reserves. So we could see a kind of splintering in the energy sector where the price of oil continues higher and you see major producers continue higher and you see some of the equipment and services plays falter. But this is kind of a theory of mine at this point. We'll see how it goes. I would think, obviously, if the price got high enough, you'd see that paradigm shift. But it takes a long time to bring new production capacity to market. So we still, I think, have this issue. If the economy is as strong as people believe, and if we've got as much pent-up demand to travel coming just around the corner, and we really haven't invested in any new production capacity over the last year, you're still left with the same basic conundrum. And the question is, will people start to invest or not in expanding it? If not, again, like I said before, the price of oil is going to go to infinity at some point here. You can't just not develop new capacity and continue to see rising demand because That's a second derivative phenomenon. You need to keep every year there needs to be a certain amount of new capacity developed because demand is growing.
All right. Let's move in, Brett, then to a discussion around the sentiment survey data. We did get the AAII numbers out. They came in at 48.9% bullish, just slightly down from the prior week's reading of 49.4. Neutral really didn't budge too much. Neither did the bearish sentiment. So really the last 2 weeks have been extremely high bullish sentiment, and fund manager survey also showed that as well. And we'll kind of break into some of those numbers in a second here. Now, in the past, when we would see highs of bullish sentiment, and the numbers are the best since you'd have to go back to early November. The last time we had a sentiment reading at these levels was 55 at that point.
For the AAII bulls.
For the AAII bulls, correct.
Not the bull ratio, because the bull ratio is considerably higher.
Not
Okay.
the bull ratio.
Okay.
But I mean, the point being that a lot of people are pretty bullish on this. And again, we'll get into a fund manager survey, and people are unambiguously bullish on that front too. In the past, we had been talking a lot about how that usually signals a top for us. However, some of the readings that we had been seeing kind of offset that, particularly in the options data. Do you think this time it's I don't want to say this time it's different, but do you think something's kind of changed with the bullish sentiment that we're getting from, say, about a month ago?
So the main message, I think, is everybody's really bullish, but they can get more bullish. In this kind of environment, if this market is able to rotate, we go through a period of consolidation, and everything doesn't just fall apart, and we start to march back up, you've still got this big carrot out in front of things. You've got a lot of retail participation. You've got an easy product to market and sell if you're Wall Street. And you've got the greatest ever Q2 comps possibility in history when you're comparing, when we get to, again, this mid-July point sitting out in the future, when you're seeing earnings come through and you're comparing year over years to what we saw last year at that time. You've got this context that's so loaded with an easy to market kind of paradigm right now. People are really bullish on the economy. As long as we're able to rotate through and rebalance in terms of kind of absorbing or digesting a different paradigm in terms of interest rates. I don't think interest rates are going to 5%. It's just we're changing to a different kind of market, but that's going to be absorbed over the process of consolidation. You've got a lot of divergences going on. That gets digested over a period of sideways action where you see, big divergences between the Dow and the NASDAQ, and things are going to swing back and forth, and we're going to settle into a new kind of allocation standard across sectors. Right now, the basic sentiment data that I see, given the context that we're in, the late stage bull market with retail participation and an easy to market kind of future paradigm, I think eventually we're going to see data that is far more exuberant than this as that process progresses. But
For the sentiment side.
Yeah, I really think that these aren't the upper limits at
Okay.
this point. I think the upper limits are probably considerably more dramatic, and we haven't really triggered that full on, I call it the flower blossoming. We've got the big stem right now, and I don't think that we've really seen the flower blossom. I could be
Yeah,
wrong.
see,
Go ahead.
I'll be interested in that because I'm kind of the mindset that I've been saying all along that the second half of the year is going to be stronger, and I think that that's going to even come in more. But so what I'm seeing is a couple of blips coming on the radar, Brett, for in terms of that could offset some of those really easy comps, right? Certainly, I mean, airlines, things like that. I mean, you can't go any lower, right? So they're still going to have those easy comps. But it seems like the global supply chain is a real mess right now.
Yeah, it is.
In the last traders meeting, I took my time to discuss the semiconductor shortage.
Yeah.
Prior to that, I had been discussing, and I continue to see the data play out with the cash transportation numbers from yesterday being the last one, transportation costs are just skyrocketing through, and it's really crimping margins. And you have people fighting for demand. So obviously, anybody that's supplying that demand, they are going to basically have a pricing war in front of them in terms of who to supply. And you're definitely seeing that playing out in commodities. The XME, another name that I've been hammering, that's been seeing a nice push higher here today, as is the IYT for that matter. But I think what we could be looking at, Brett, is a little bit of a shortfall in these Q1 and early Q2 numbers due to the supply chain mess. And I'm wondering how much that could offset um, some of the enthusiasm that's out there in the markets if these numbers start coming in a little bit lighter than what's expected. And that's probably the one thing that I could see tripping up this current move here. And we're certainly, obviously, you got the rates as well on top of that story. But you got any thoughts on the supply chain and how that could impact some of those year-over-year comps?
Yeah, sure. I agree with everything you just said. I think that let's chalk that up as part of this process of consolidation and adjustment to a new
Yes.
universe. So there's going to need to be investment. We're going to need to refine that process, but it doesn't sound to be cyclically fatal. And as we consolidate, perhaps the time frame is elongated. The breakout is later in the year, but
And,
it doesn't seem. It seems to be a transitionary process.
and I think that the key term you used was cyclically fatal. This is more of a push out dynamic than a halting all shipping dynamic at all or anything like that. Could trip up a couple of companies though, have planned poorly for this or lose out on some orders because of their supply chain. So that's definitely going to be a dynamic. But I think, like you said, Brett, that just kind of points to me towards a little bit of a choppier move over the next few months that leads us to a bigger run in the back that could get that little blow off top that you were talking about.
Yeah, and since we're already diverging in sectors, we may already be in that period
Yeah,
in
yeah.
terms of market patterns. Yeah.
So, it's going to be something that we're going to watch play out here. And I think really it's going to be a pretty key item going into the Q1 earnings. The other thing that I wanted to throw at you on the inflation side, Brett, obviously there's been a lot of talks about the rise in PPI as of late, a lot of comments from companies about higher costs of goods, and we just talked about the transportation and metals on why they're seeing that. But what do you think of for the battle that Powell is going to have around inflationary pressures, cutting into company margins, and eventually starting to see some talk about this getting passed along to the consumer, and I think that's going to be a key theme in the Q1 earnings. So how do you see that playing out in terms of Powell's world, and what do you think that the Fed is going to have to do in order to offset those worries?
So I mean, I have no idea of the precise answer to your question, but I can say that I think the Fed is engaged in a process where it wants a bit of that.
You think that they're totally going to be fine? You don't think that they
I think they
flinch at
want that
all?
they're trying to spark exactly that, even if it means that it crimps some processes. I mean, I think that they need there to be some inflationary expectations building into the picture at the consumer level.
Okay, no, that's a fair assessment. So, Powell does not budge at all on this. He stands pat with the transitory commentary,
It
and
seems to be, yeah. I mean, it
yeah,
doesn't seem
yeah,
to be. I mean, unless we get disorderly movement or just, I mean, if the 10-year moves to 2.5% tomorrow, that
right,
changes.
right.
But
That changes the aspect. And the CME Fed Funds futures, if anybody's curious, but I don't know if you saw that, it was up to 9.9%. Still
yeah,
a blip on the radar, but it has
but the
doubled over the last couple of.
euro dollar futures forward curve is showing that they're like a year and a half ahead of the Fed now.
Really, for
Yeah.
the ECB to tighten in front of the Fed.
No, 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 no. The euro dollar futures are on dollars. So in that framework, it just means external dollars external to the United States. So
So the outside community is betting that we're going to raise before
well, the
the
difference
domestic.
between the difference between cost of money from the Fed's window and the cost of money from one window to another outside of the United States shows a disparity, and that disparity is a predictor of when the Fed is going to hike rates. It's the natural rate where the Fed should be, et cetera. So you look at the forward curve, you can see where people are betting it's going to be, and right now, in other words, what it means is the private sector and the private financial uh, 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 participants, agents, including Wall Street, so inside the United States and outside of the United States, all around the world right now, they're betting that the Fed moves much earlier, June 2022.
Okay.
And the Fed's talking about, early 2024. So we've seen it, the same thing come out from analysts. We talked about them yesterday. There's been a number of Goldman Sachs thought the Fed was going to change the dots considerably yesterday.
Yeah.
And it didn't happen. So I think that the Fed is aware of this, and I think that they're playing the game right now to try and create a gap between, let's say, as a heuristic, between the euro-dollar futures and the aggregate dot. Then that gap is driving the long end of the curve higher and driving up inflation expectations. That's the engine of the inflation expectations, is that gap. It's what I called the Fed being performatively, irresponsibly asleep at the wheel. Trying to emphasize that we're going to be not at all proactive about this, even if everybody expects us to be, and that's how you build inflationary expectations, which is what it's trying to do.
Yeah,
that's my view.
Yeah,
So, and I think euro-dollar futures displays it.
No, I think you've got some solid elements to that discussion there that supports your view too. It'll be interesting to see what happens if other central banks do continue to tighten. I've seen commentary from China officials that have raised some concerns about the U.S. and now we got Japan going on too. And at some point the U.S. does need the overseas central banks to buy the Treasury. So. But it's going to be an interesting dynamic playing out and see how Powell navigates it. But let's move on then, Brett, to the fund manager survey here. And there's a lot of interesting elements to this that we wanted to discuss. And first off, let's just start.
So let me just, before you start, let me just say for people, so this is the Bank of America Fund Manager Survey. Gavin and I talk about it all the time on the show. It's one of the main inputs that we have. And in that, you've got like a couple hundred major funds with $500 billion of assets under management answering a series of questions. And the results of that give us a sense of where large money players in the market are leaning in terms of their expectations.
Yeah, this gives us sentiment and flow, right, from the people that are making the monetary decisions for a lot of groups of people. So again, the fund manager survey, Brett, extremely bullish, and we'll get into some of the details. But let's jump into the first point here about tail risks, which we both found pretty interesting. We discussed it a little bit last time, but COVID-19 vaccine rollout has nearly fallen off the cliff here for the focus. It's dropped to the third biggest concern. It was the top concern at about 29% last time. Now it's down to only about 14% of the survey respondents had this as the top concern. What had moved up into number one and number two, and I think we could argue that you would combine these two, is higher than expected inflation. It's now tops. It was number three last time. It's running at about 38%. And a tantrum in the bond markets is number two, running at just under it at 37%. Collectively, that's 75% of the biggest tail risk for markets, and you could argue that they're one and the same. So really just highlights the fall off of worries around COVID and, again, kind of helps build that reopening trade too, Brett. So what's your thoughts on the changes that we're seeing in terms of what people are looking at?
Yeah, I think that it demonstrates why it's important to be watching the bond market while you're trading stocks right now, because there's so many people with such massive assets under management that are basically looking at the world through that lens as being the gatekeeper for every decision. Like, what is your expectation of where interest rates are headed? So it's an obsession right now for major equity managers. And I think that, it also demonstrates, by the same token, how effective the last few weeks have been in terms of the vaccine rollout.
Now, if you're trading off of rates too, just to go off that, Brett, your first inclination is always going to be to go after the NASDAQ. Would I be correct in that, of the three indices?
Well, yeah, I mean, there's the duration risk in terms of growth stocks, and it also seems to be a market habit now that's locked into place.
Yeah.
That has real meaning when you start to get everybody gaming the same idea, there's a kind of recursivity to that glues it together, and a lot of the market is really just about that sort of recursivity. So yeah, I mean, it's also the place where we did have the most loose speculative capital as of a few weeks ago. I don't think that that's any more the case, but it certainly was, and it takes a while to work that off.
All right. And just if you're curious, too, it's the first time since the February 2020 survey that COVID was not the number one tail risk.
First time since when?
February of 2020. So
There you go.
since COVID's been a thing, if you will,
Yeah.
from the WHO's global pandemic warning, this is the first time that that has not been the top concern. So
So it's sort of a huge kind of event for the market for
it
that to
is.
shift.
It is particularly, and I mean, we've seen it play out in reopening. I mean, look at the airlines now; they're getting to levels above COVID and stuff. So,
It's kind of nice,
it is.
actually.
It would be nice. It would be nice. Although I saw people who are 16 years old are going to be getting the vaccine in front of me now, Brett in Illinois. So I'm not too thrilled with that, but it is what it is, right? And if you're curious, the bubble on Wall Street was number four. Number five, Brett, was higher taxes and sixth greater regulation, which I think the taxes and regulation you could always talk about. Again, the Democrats being able to push their agenda through, but of course, this should be offset by the fiscal policies that they're trying to implement too. So it's going to be interesting to see how that plays out in the coming months for the
Well,
stock
and
market.
I wouldn't skip that fast after skip past the bubble on Wall Street moving down so dramatically as well, because
Yeah.
that there's kind of a second order sentiment data point mixed into that.
Yeah, and if you're curious, the bubble in Wall Street dropped from about 14% of respondents to about 7%.
And
So,
let's just say that, I mean, to me, what that is it's another one of the sort of side benefits of the way that Powell has managed the situation. Because we talked about this a little bit yesterday, but if you look at the situation, he didn't capitulate to the early seeming dislocation going on in the bond market, and he just stayed the course. And what happened was all the areas of the stock market that were serious bubble risks crashed, but the rest of the market held up. Right? You mean there's one way to look at it. Kind of the most speculative areas of the market came in sharply in response to that. And in a sense, one of the Fed's problems as of a couple months ago was bubble risk in the market. So it's been a productive process.
yeah, no, it definitely has, and you got to tip your cap to Powell to be able to pull it off so far. We'll see if that continues. All right, Brett. 91% of investors expect a stronger economy. This has remained one of the more bullish points from the survey the last couple of times. Probably not surprising. Again, talking about the easier comps, but I'll be curious to see what we see in a month from now if those supply chain issues come, because we'll be getting this survey right around the start of earnings season, and we would have had the ability to digest a lot of early guidance for
Right.
pre-announcement season. So
No, but I think this data point is the most, to me, it's the most characterizing data point. If you look at the path of this data point going back the last year,
yeah,
we talked about this a lot all the way through September, October, November. It was a tiny fraction of fund managers who thought it would be a V-shaped recovery. And what's happened over the last really 2 to 3 months has been this paradigm shift from this is going to be this long, drawn out, years level kind of hiccupy process to being boom, V-shaped recovery. That's what's happened in the last couple months is that paradigm shift, and it's the same thing that we're seeing in the interest rate markets.
yeah. And what we saw 6 months ago in the stock market, right? Once again, showing the stock market to be a forward-looking
Right.
indicator. All right, so profit expectations are expected to be higher. That's at net 89% of FMS investors expecting global profits to improve over the next 12 months. This is up 5% from the prior month over month, and surpasses both February 2nd and December 2009 as the all-time highs
Yeah,
for
all
this
time
data
highs. Yeah.
point. So again, this talks about the easy comps to you. But again, Brett, given how high these expectations are, those rising input costs and supply chain issues, I
Hmm.
mean, I've been seeing a lot of people guiding EPS below consensus and revs above consensus. And that's a dynamic that's opposite from what we were seeing
Yeah.
2, 3 years ago when people were really just cutting costs and not really growing the top line. So really
Yeah.
curious to see how markets look at, and obviously it comes into valuation. You got any thoughts on that?
Well, so first, I just want to put this back in the framework of our previous discussion. So, what that data point again says is the most for the whole history of the survey, which goes back into the 1990s. This is the greatest percentage that we've ever seen of people who expect a stronger economy ahead. And if you look at the way that I characterized the move in interest rates earlier, as in the near term expected return on invested capital versus the long term expected return on invested capital, the shift to this sudden change, the V-shaped recovery, this, more than 9 out of every 10 fund managers thinking that we're headed into a roaring economy. It just goes to show you what's really behind what's happening in interest rates is nobody wants to be a lender right now. People want to be a borrower, and that drives up interest rates.
Yeah, no,
And we
very
need to
good
adjust
point.
to that. I mean, that's a change, but it doesn't. It's not necessarily a change that means everything's going to fall apart. It's just that's not the way that the market was positioned. It was positioned for something very different on a really deep level, and it takes a while to transition to that new positioning paradigm.
How much of these all-time highs, Brett, do you think are associated with just the fact of more groupthink going on? You got people sharing ideas on Twitter,
Sure.
looking at the same blogs, watching the same TV shows and stuff.
But you know what? That's the interesting thing about economics is that can actually be important. People
I'm not,
expecting a strong
yeah,
economy means they'll invest money and buy things and open new factories and spend their money and not worry about saving and et cetera.
yeah. And just as we're talking here, we see Nasdaq hitting session lows down at 12,814 at the moment here, Brett. So should have stuck with that one, huh?
Yeah.
It all comes back to I just tightened my stops
Yeah. It was a
too much there. I should have left.
It was a nice shakeout leg there.
Yeah. Okay, let's take a look. CIOs continue to want CEOs to invest more in CapEx. So
Same thing.
same exact thing, just kind of building on the dynamic that we're talking about. Rather than buying debt, they want to see growth. So, and that's what we're going to get, I think, with
We've
a
got a
lot.
return from investing now in expansion.
Exactly. Steeper yield curve expectations actually fell a little bit, Brett. And this was one thing that I was talking with you a little bit about. And, I'd be curious, seeing rates move this quickly, I think that there's got to be a little bit of a stumbling in the financial engine here that could, possibly flatten the yield curve to a certain degree. We're kind of looking at the move in oil here. I don't know if that would be something that you'd look at that could start weighing in a little bit on the long end of the belly here. But what's your thoughts on expectations dropping off? And it fell 16% month over month in terms of expecting a steeper yield curve. You got any thoughts on that?
No, but I think that I could kind of work that into a narrative of just believing that people who are managing money see the Treasury market as maybe a little bit of a forward-looking indicator on what's coming, and the adjustment in yields. You're always willing to say, well, maybe the adjustment that we've seen over the last couple of months is pricing in the economy that we're heading into over the next couple of months, and therefore the bond market has already made its move, and the economy is going to start to exhibit the characteristics that the bond market was pricing in. And therefore, we've got a really dramatic steepening that we've already seen, but it may just be kind of a case of recency bias, and it's possible that this is actually going to get more dramatic. But if you look historically, it's a pretty dramatic steepening, and the other way to look at this is, maybe the expectations are that pretty soon the Fed is going to start to change its tune, and then you have the short end of the curve moving up as well.
Yeah. And just seeing a little bit of a defense here in the Nasdaq, so we'll continue to monitor that. All right. Let's see. And there was a 16% month over month rise, of course, in the higher short term rate expectations. It's just obviously the flip side of what we were just talking about. Inflation expectations, Brett, now at an all-time high. Net 93% of fund managers surveys expect higher inflation the next 12 months, up 7% month over month. I remember when we were talking about this in negative territory
Hmm.
here, Brett, and that's when we started talking about getting that reflation basket together.
Right.
And it's really paid off in droves.
Yes.
Now, when we're looking at a number like this, do you say Pals won the game on this, given this fund manager survey expectations? We saw, I don't know if you saw the Philly Fed this morning, Brett. That was at an all-time record high for its pricing expectations segment of the survey. And, everybody's expecting inflation. It's certainly been reflected in the rise in yields. You could argue that we're not quite at Volcker level on yields, so it hasn't necessarily hit home. But these things tend to go in 30, 40-year cycles, right? And do you think we're at the beginning of that reflationary cycle at this point?
You
And
mean so it's like structural time frame?
yes.
Yeah, I mean, my sense is that's a more demographic issue. I think the number one correlated variable that I've seen with that is the year-over-year change in the size of the civilian labor force for people 25 years old to 54 years old, and that's certainly heading in the right direction. But as far as short-term dynamics, I think that Powell's won the game if Main Street looks like this. So Wall Street, we've got all-time high expectations
Yeah,
of
but
inflation.
I just mentioned the Philly Fed one,
Right,
and
right.
and that's
But that's
from
that's what I mean. That's not really your average consumer.
okay. Yeah, yeah. I mean, I would, yeah. So your average consumer. So if we see the next University of Michigan
Yeah.
fund sentiment survey, and that's at all-time highs, then you think Powell
Well,
has
I
that.
mean, in theory, yeah. I mean, it's built on expectations. So if people start to assume they'll behave differently, and that becomes a self-fulfilling prophecy for at least some time frame. But
Okay.
I don't know if it's a winnable game. I'm just saying I feel like that's the agenda in play. I don't know. I also feel at some point that there's going to be this choice where the Fed's going to choose between continuing to attempt to play that game and preserving its credibility. And I think ultimately we'll decide on preserving its credibility. And I think that's why the Eurodollar futures are pricing in a much earlier hike.
All right, fair enough. All right, higher growth and higher inflation is now the consensus. This has taken over the peak Goldilocks, which was higher growth and lower inflation that we've been enjoying for certainly the last year and probably the last couple of years. Any thoughts into the change in that dynamic? I mean, it's pretty much rolls out with what we've been talking about here, right?
Yeah, absolutely.
All right, then some thoughts on the 10-year Treasury market. Fund manager surveys were asked what level in the 10-year Treasury makes bonds attractive relative to stocks. The number one answer for this, Brett, was 2.50%. That was about 34% of the respondents. 3% was the next level up at about 30%. Now, then we dropped down to 2% being the third number, and obviously the one that's probably most likely in our radar. They did have 1.5%. There was only 4% of the people thought that was going to be something that would really entice people, but 2%, that came down to about 19% of it. So, do you have any thoughts on these numbers that we're seeing here?
Yeah, I think it's interesting that it's not just above the S&P's dividend yield or something. I think it's interesting that it's 2.5%. I'm not
Well,
sure really what to make of that, but yeah.
yeah, so that's the numbers that we're looking at. I think 2% obviously has a nice round psychological feel to it. We've kind of
Certainly.
blasted through that 1.5%. So, and
Which is around the dividend yield.
yeah, so real rates now are in positive territory for the first time in a while, right, Brett? When's the last time it was in positive territory for the real
I don't
rate?
know. It's a good question, but
Yeah.
pre-pandemic.
Yeah. So, all right, then the second question was when do investors think the Fed will hike rates? The number one answer was first half of 2023. Number two came in the second half of 2022. Three was second half of 2023. So as you can see, we've got a pretty fair amount, not looking for anything anytime soon. Four came in the first half of 2022, and then you got to go all the way down. The lowest answer, Brett, was 4% Are you expecting a big, and that's for 2021, just this year? We talked about the CME Fed funds futures. Are you expecting to see that kind of move more in line with the euro dollar? Some
Yeah,
movement
I
in
think it probably
fantasy.
fluctuates a lot. But what I think is interesting is that only 6% of respondents agreed with the Fed.
Yeah,
I mean, the dots of so this is the same disparity that I'm talking about. It's like you're building the long end of the curve, you're building the steepener trade, you're building inflationary expectations by the fact that the Fed keeps hammering home a timeline for this that nobody thinks is reasonable,
yeah, and that
and
kind of
saying that we're going to prove it. I mean, like we talked about that line yesterday, they're saying we want to build credibility in this. We're going to prove it. We're going to
yeah,
do this. We're actually going to do this, and everybody's like, this is ridiculous. You can't
yeah,
wait that long. There's no way that's going to play out. And
and it
so
builds and
it shows up in the rising rates and the rising inflation expectations.
And it builds off of the next data point, which was that 28% of FMS investors think policy's too easy. This is the lowest level since November of 2018. So just shows that fund managers think
Fiscal
that,
policy, right?
yeah,
Yeah.
yeah, yeah. So, obviously, this kind of builds into how much fiscal policy is too much, right?
Yeah, I think that they were maybe okay with 1.2 billion or trillion.
Yeah, yeah. So, and don't forget, we got infrastructure policy starting to get discussed here. So that is going to come into play too. All right. Then the next point we're going to cover, Brett, is the spread between equities versus bonds is overweight, close to the highest ever. That means the amount of money that's in equities compared to bonds firmly in play. Now we're seeing those rates start to even up. We just talked about the real rate. And the other thing that we want to point out, Brett, and you're always a big this is always a big discussion point for you, is we're getting towards quarter end, and there's a lot of those fund managers that have the 60-20-20 portfolio where they have to have a certain amount of their cash in bonds.
Fixed weight managers, yeah.
Exactly. How do you see that playing out in the next 2 weeks?
So, okay, so this is interesting. So the theory would be that, okay, so let's say your chart, you run a fixed weight fund, you have $100 million or something, and there's lots of these guys out there, and they've got a charter, and it says they need such and such amount of their exposure at every given benchmark point. Some of them are monthly, some of them are quarterly. I think rarely they're annually, but quarterly is a really common one. And it means that at the beginning of each new quarter, you need to have, let's say, just for the sake of argument, 70% of your money in equities and 30% of your money in bonds. And that's just the way that the charter says it. You need to make those adjustments. So if you don't make any changes, along the way, then you're going in terms of position adjustments, so no turnover. But what we've seen lately is the value of the bonds that you hold go down dramatically, while the equities have stayed fairly even or gone up a little bit. It depends on exactly what your exposure profile is. But the equities part of your portfolio has stayed the same value. The bond part of your portfolio has gone down a lot. What that means is, as you switch from one quarter to the next, to get back to your chartered levels, you're going to need to buy a lot of bonds. So it should be that we start to see massive bond buying coming in just around the corner. It doesn't necessarily mean it's going to change where the rates are going to be. And I
You don't
call
you
on
don't
my
think it could stave off some of the rate
Well,
pop
so it
we've
should be
seen?
an increase in demand, but I'm going to throw at you the rubber ducky bathtub metaphor
Okay.
to say that the price that people agree on doesn't necessarily, there could be surging demand, and it still could be something where people know that they can collect just as much as they want to by getting their price. So if the future projected price of the people interacting with the bond market around the corner after this event is for bonds to be much lower than this and rates to be much higher than this, then it's not so hard for them to get to their quota by sitting and buying on a declining price. It depends on how much competition there is. It depends on other dynamics. If for some reason there's a seller strike in the bond market, I don't know why that would be. Maybe perhaps around expectations of the same event. It doesn't necessarily have to drive rates down, is my point, just because there's this adjustment. But yes, it's a source of demand. It's a source of inflows into the bond market. The alternative is that we have seen such a dramatic paradigm shift in terms of expectations that you might actually see some of these fixed weight fund managers call the board in and change the charter
Yeah.
because their outlook for the bond market over the next, look at what Warren Buffett just
Would
came out and
that be
said.
announced?
Well, I mean, you've got a lot of smaller players that are in this situation. I mean, I don't know
Yeah.
if we would see that announcement. But I mean, maybe there's a chance that somebody would, the sovereign wealth fund of Finland or something. I don't know.
Right. Yeah.
But either way, it may be that the choice is the outlook is so certain about a paradigm shift in the bond market, and maybe this is a sentiment data indicator as well, if we see this, that you actually see people shift their charters rather than do that bond buying. I'm not sure I would suspect that they would continue to hold the charters, but I think that there's probably some renegotiation of charters that could happen rather than pouring their investors' capital into bond buying when there's such a dramatic sentiment shift in terms of interest rates.
Yeah. All right. Okay, so I think that's going to do it for us here, Brett. I mean, we're obviously going to continue to keep an eye out on this dynamic with the end of the quarter rebalancing, see if that does come into play. We'll both be providing our commentary on rates. I know you'll be talking a lot about oil, and we'll be looking around for that. But, for me, uh, from my biggest takeaway from this is that we're going into Q1 earnings with a lot of uncertainty about rates, but a lot of perceived certainty about how strong this upcoming quarter is going to be. And I think that's a pretty big item considering that we've got some signs of the supply chain faltering a little bit, which could, lead to some misses in earnings and the top line going down the road. And I'm just kind of curious to see how people are going to be able to negotiate that. So for me, I'm looking at a little bit of a choppy action as we work our way through this changing period in time. I think overall it's going to be pretty healthy, but we're going to see a lot more of that health reflected into the back half of the year when the supply chain issues have kind of settled and you still had that money that was sitting around in the coffers finally getting put into place. So it's going to be a little bit of a balancing act for companies to be able to offset any sort of misses in the overall numbers given the high expectations with the idea that this is coming down the road. So that's the big story for me in the markets. But until we get some of that, and particularly in the short term, I'm a little bit on the cautious side. So that's my take, Brett. What's your biggest takeaways and how are you kind of proceeding moving forward here?
Yeah, I mean, I'm really looking forward to it. I think we're going to have a more interesting market than we've seen over the last several months. To me, it's been an uninteresting market, a really bottom up, really stock pickers oriented, consensus expectations turning out to be true kind of market. And I really, that's not generally speaking my wheelhouse. So I've been relatively inactive on a rolling 2 month basis than is typical. And I'm looking forward to a period where we've got some divergences and we've got two-way action and we've got some surprising and interesting moves that catch people off guard rather than just plodding slowly in the direction that everyone expects. And I think you're right. There may be some unforeseen variables that come into a picture that people are making perhaps vastly too complacent, extrapolative conclusions about. And I think that if people are underestimating how much damage there could be from a supply chain situation that's really not functioning properly right when demand goes crazy, there could be some interesting shortfalls in expectations that catch people off guard, and you see repositioning. I think there's an opportunity for a lot of really interesting trading themes.
Yeah, I completely agree. So, we'll continue to expand upon them as we move forward. But for now, Brett, I think that's going to do it. Do you have any other parting shots before we go?
No, I think we covered it all there.
All right. Well, always a pleasure, Brett, talking with you about this. It's fun just kind of hammering things out. We will be posting the recording a little bit later here. So if there's any questions or any follow-ups, please let us know, and we'll probably circle back around and answer those when we get a chance.
All right, thanks a lot, Gav.
All right. Talk to everybody.